this is a sample investment analysis for a stabilized apartment property. And these numbers are hotspots to jump you to where that concept is explained on the other sheets of the workbook. And then you can click back to the place where it exists in the sample analysis as such. So we encourage you when reviewing the material to take advantage of this sample analysis tab and look into the instances of the usage of these various techniques and functions. The one thing to be careful of is that it's grabbing all of the rows that you want and no rows that you don't want. For instance, let's say this row were to be a subtotal, and I really only wanted to grab these two rows. Well, if you were to do alt equals here, you would then need to just go in and modify it such that it didn't grab the extraneous row in that context. And if we round these two individual items, we don't therefore need to round the total because they're already rounded to whole numbers. And just to be clear, the convention that's being observed here with the rounding is if you have any fractional amount greater than or equal to 0.5, it's going to round up, and anything less than 0.5, it would round down. So if this had been a higher square footage, such as 875 square feet, we would get 14.29 units, and that would therefore round down to 14. And we can do it in the following way: equals the lesser of the periodic cost and the total equity commitment anchored. And technically, I don't need to anchor the row, so I can just anchor the column if I'd like, minus the cumulative sum through the prior period. Not through the current period, but through the prior period. If I were to extend this through the current period, which would be column F, I'd be creating a circular reference and I'd get some funny results. There is an alternative approach, which we'll show you here, and it requires that we establish the threshold value, for instance, $1,000 a month. And then when we program in the criterion for that threshold, what we do is we put just the inequality in full quotes, and then the and symbol, and immediately following the and symbol, the cell reference to that threshold variable. And this is a certainly more dynamic way to program this, because it then allows us to change the input and have the formula update dynamically without having to touch the formula itself to get this new look into the data set. Let's say we just want to copy and paste the numeric value, 30,500. Let's do this together. We'll do Control-C on PC or Command-C on Mac. And then let's navigate with our arrow keys to cell F as in Frank 12. Now that we're in the destination cell where we want the pasting to occur, we're going to do on PC Alt-ES. On Mac, it's Command Control V, all at the same time. And that brings up the dialog box. To select values on PC, type the letter V, or use your mouse to select that radio button. On Mac, you need to use the mouse to select the radio button. And then last, hit enter. And so what we get is an unformatted 30,500 without any formula either. If we look in the formula bar, there's no formula. It's just the numeric value, whereas the source cell did contain a formula. The formula syntax for if statements is what we show here, which is if, open parentheses, state a condition, and then if that condition is met, perform action X, and if it's not met, perform action Y. Here's an example. If the mortgage is paid late, there's a penalty charged to the borrower. And so if we wanted to represent that concept, we can, if we would like, create a drop-down menu that has choices for yes and no, or we could simply type the word yes into a cell. And then when we write the formula, we can reference that cell and check to see what is currently residing in that cell. So let's just say, for the sake of illustration, the penalty is a $15 penalty. And so if we take a look at this formula construction here, it says if the contents of echo 13 are yes, then return this penalty dollar amount. The first thing we do is consider the impact to vacancy if the tenant does renew, right? The 60% chance that they do renew. Well, if they do renew, there's a 60% chance that vacancy is 0 because they're paying rent. Plus the probability that they don't renew times what the then market rent would be for that year, divided by 12, get to the monthly amount, times the number of months of vacancy. And if the current year is neither year 3 nor year 6, we're going to simply return 0, meaning vacancy for that space is 0. Inversely, if I change the renewal probability to 100%, I get zeros across the board because the in-place tenant is simply staying in place. So whenever you come across a situation where it's a little bit conceptually complicated, sometimes it can help to manipulate the inputs to get some better mental traction on what you're doing and whether it's coming out in a way that you would expect. On the back end of this formula, similar to what I did with beginning balance, I have an if statement which says times if the current month exceeds 300, then multiply this by 0, meaning turn it to 0, otherwise multiply by 1. And if I didn't do that, this PMT will just give me that 6443 forever. So regardless of the length of my loan amortization, I could have a table that supports 480 months and a 20-year amortization. It'll give me that payment amount for all 480 rows. So that's, again, a presentation choice that we make here to ensure neatness of presentation and to not allow anyone to potentially misinterpret what's happening with this loan. These types of loans are useful in a value add transaction context where you're acquiring a property that, let's say, has 20 to 40% vacancy, and your business plan is to fill the building back up. Well, you have to buy the entire building, but you don't get a full building's worth of NOI right out of the gate. So interest only is going to provide some relief on the size of the debt service payments because they're just interest and not a combination of principal and interest. And last, for the principal portion, we're able to really simplify this to test to see if the loan month number is within the interest only period, then simply return a 0 because it's interest only. Otherwise, take the difference between the same period's beginning and ending balances, which by definition is the amount of principal that's being repaid in each month. This streamlining of this formula is made possible by implementing the future value function to provide the ending balance. If we did not have this at our disposal, we would run into a circular reference where we would say the ending balance is the beginning balance minus the principal, and the principal is beginning balance minus the ending balance. So because we know that we can implement the ending balance in that alternate way, we're able to get a satisfactory, in my graphs, I have the same profiles that I had originally. And I can also test it with a partial year, so I could say 1.5 years of interest only. And so I scan my eye down and I see there's no principal for the first 18 periods as opposed to the first 12 periods. This is actually fractional now. So to show that, do Alt H0, that's 23 and a half years of amortization. As a result, my payment is now, upon amortizing, $66.23. Whereas if it were just a 1 year, it's $65.60. So the more interest only that you have, the higher your amortizing payment when it kicks in. Again, assuming that the term of amortization is reduced by the interest only period.